the Sasin School of Management. It's my pleasure to welcome you to the Sasin School of Management Bridges Nobel Laureate Talk, A Financial Approach to Climate Risk. Before we begin, I'd like to recognize our guest speaker, Nobel Laureate Professor Robert Engle III. It really is a pleasure to have all of you here today and in this distinguished company. And to start things off, to give his opening remarks, we are honored to have the president of Chulalongkorn University, Professor Bundet Uwe Morawetz.
Good afternoon, everyone. Faculty, students, alumni, and distinguished guests, it's my profound honor to welcome you to this very special event at Sasin School of Management. My sincere thanks to Professor Ian Fenwick and the Sasin team for hosting us today. And today's event, we are privileged to host a figure of immense repute in the fields of economics, Nobel Laureate Professor Robert Engle III from the Stern School of Business of New York University. Professor Engle's groundbreaking work has reshaped our understanding of financial markets and risk management. It is a rare opportunity for us to learn from such a visionary thinker, especially on a topic that is of critical importance to us all. The theme of Professor Engle's talk, A Financial Approach for Climate Risk, could not be more timely or relevant. As we stand at the crossroads of environmental sustainability and financial stability, understanding the nexus between these two areas is crucial for shaping a future that is both prosperous and sustainable. Climate risk is not just an environmental challenge. It is a multifaceted threat that affects economies, societies, and the very fabric of global finance. In addressing this, we are called upon to innovate, to rethink traditional models, and to embrace new strategies that safeguard our planet while ensuring economic resilience. At Chulalongkorn University, and particularly here at the Sasin School of Management, we are committed to advancing knowledge that addresses the world's most pressing issues. Hosting Professor Engle's lecture is a testament to our dedication to fostering a dialogue that bridges academic inquiry with real-world application. It is an honor to facilitate discussions that not only enlighten, but inspire action towards a more sustainable and financially stable world. To our students, faculty, alumni, and guests, today's lecture is a unique opportunity to engage with cutting-edge research that has significant implications for our understandings of climate risk and financial markets. I encourage you to actively participate, to question, and to take these insights back to your communities and organizations. In closing, I would like to express my deepest appreciation to Professor Engle for sharing his expertise with us. Your work continues to inspire a new generation of economists, policymakers, and leaders. To everyone present, thank you for being a part of this important conversation. Let us make the most of this opportunity to be inspired, to connect with new colleagues, and to transform our thinking as we collectively work towards a future where sustainability and finance go hand in hand. Thank you, and I look forward to stimulating and enlightening discussion.
Thank you, Professor Pundit. Now I'd like to welcome to the stage the Director of Sasin School of Management, Professor Ian Fenwick.
So, first of all, welcome to Sasin. It's good to see so many faces familiar and some faces new. We're here today for a very special reason, and that is to have the honor of hosting Nobel Laureate Professor Robert Engle III from Stern School of Business in New York. I want to thank Professor Engle for accepting our invitation to come today, and welcome him and his wife Marianne, who is also here, Dr. Marianne Engle. And I'd like to thank the International Peace Foundation and the Bridges organization for coordinating this event. And I'd like to thank the series sponsors, BMW, Dusiteni Hotels and Resorts, Kasikorn Bank, and the Mitsui Fudosan Group. Professor Engle is one of the world's leading experts on financial econometrics. And for me, it's quite a trip back in time. So once, long ago, before I was a marketer, before I was led astray, I was an econometrician. And I actually looked at some of the problems that Professor Engle has dealt with so well, including heteroskedasticity, which I have to say is one of my favorite words, and anyone who can spell it will get entrance to Sasin. Today, Professor Engle will share his insights on a financial approach for climate risk, a topic which is of urgent relevance for our society and our planet. As we face the challenges and uncertainties posed by climate change, we need new tools and new frameworks to measure, manage, and mitigate those risks. We only have to go outside today and breathe deeply to understand the impact of climate change on every part of our life. At Sasin School of Management, sustainability is a core value that guides our teaching, our research, and our outreach activities. We believe that business leaders have a crucial role to play in promoting sustainable development and addressing the environmental, social, and economic challenges of our time. Professor Engle's talk is perfectly attuned to our mission, as it will provide valuable insights into how the financial sector can contribute to mitigating the risks associated with climate change. I'm sure we'll all benefit from Professor Engle's research and experience, and his talk will indeed stimulate our thinking and inspire our action. Thank you.
Thank you, Professor Fenwick. Now I'd like to welcome to the podium our co-organizer, the chairman of the International Peace Foundation, Mr. Uwe Morawetz.
Yeah, welcome to the Japan-ASEAN Bridges event series, which is facilitated by the Vienna-based International Peace Foundation. The events are hosted in cooperation with various local partners, including the country's major universities, and I would like to thank Sasin School of Management for hosting our event today. Commemorating the 50th anniversary of official relations between Japan and the ASEAN region, Bridges has been continuously held in Thailand and Japan since November last year, involving the participation of Nobel Laureates for physics, chemistry, medicine, and economics. The Japan-ASEAN Bridges series follows the series of over 800 Bridges events, which the International Peace Foundation has facilitated since 2003 to support education in the ASEAN region. The pluralistic program of Bridges highlights the International Peace Foundation's intercultural and transdisciplinary approach towards peace. The foundation doesn't take sides, but acts as a mediator by creating an independent platform for dialogue where representatives of science, politics, economy, culture, religion, the media, and youth can meet, share their viewpoints, listen to each other, and find mutual ways of understanding and cooperation. The aim of Bridges is to facilitate and strengthen dialogue and communication between societies in Asia with their multiple cultures and faiths, as well as with countries in other parts of the world, to promote understanding and trust. The events aim at building bridges with local universities in Asia to establish long-term relationships with Nobel laureates in all fields, which result in common research programs and other forms of collaboration. By enhancing science, technology, and education as a basis for peace and development, the events lead to a better cooperation for the advancement of peace, freedom, and security in the region, with the active involvement of the young generation, our key to the future. This is why Bridges is not designed as a one-time event, but as a continuing process of synergies of now over 2 decades to make the series of events a sustainable success for Thailand and for Asia as a whole. I am grateful to our honorary chairman, Anand Panyarachun, and to our partners and sponsors who have enabled us to make the idea of Bridges a reality. I would like to thank everyone present today for taking part in this program. May it help us to facilitate a new culture of peace through dialogue, transcending its definition as merely the absence of war or armed conflict into a new understanding what the basis for peace is: education. In this spirit, we welcome today the 2003 Nobel Laureate for Economics, Professor Robert Engle, and his wife, Dr. Marianne, who have again agreed to come to Thailand to support the events. We all look forward to his keynote speech and to his important contribution to build bridges. A warm welcome, Professor Engle.
Can I ask Professor Bundit, Professor Ian Fenwick, and Dr. Uwe and Mr. Uwe Morawetz and Professor Engle to come up on stage for a quick photo? While we do that, let me just review our agenda for today. So we will have Professor Engle's presentation. Then we will have a panel discussion with 2 of our faculty members from Sasin. And then after the panel discussion, we will have some refreshments out in the foyer, just outside Sasin Hall here. So that is the agenda. Okay, thank you, gentlemen. You can return to your seats. Now we come to the highlight of our program today. Our guest speaker is a 2003 Nobel Laureate in Economics and Professor Emeritus of Finance at New York University's Stern School of Business. A member of the National Academy of Science and of the Advisory Board of the International Peace Foundation, he is also the co-director of the New York University Stern Volatility and Risk Institute and a co-founding president of the Society for Financial Econometrics, a global nonprofit organization housed at NYU. Professor Engle graduated from Williams College with a BS in physics. He earned an MS in physics and a PhD in economics, both from Cornell University. After completing his PhD, Professor Engle became professor of economics at the Massachusetts Institute of Technology. That's so difficult to say, even for me. from 1969 to 1975. He then joined the faculty of the University of California at San Diego, where he became a professor in 1977 and later the chair in economics. He now holds positions of Professor Emeritus and Research Professor at UC San Diego and has also held associate editorships on several academic journals, notably the Journal of Applied Econometrics, of which he was co-editor. In 2003, Professor Engle shared the Nobel Prize for Economics with Professor Clive Granger from UC San Diego for developing methods for analyzing economic time series with time-varying volatility. He conducted much of his prize-winning work in the 1970s and 80s when he developed improved mathematical techniques for the evaluation and more accurate forecasting of risk, which enabled researchers to test if and how volatility in one period was related to volatility in another period. This work had particular relevance in financial market analysis, in which the investment returns of an asset were assessed against its risks, and in which stock prices and returns could exhibit extreme volatility. That's more than a mouthful for a non-finance guy like me, let me tell you. Today's talk is on a financial approach to climate risk. Ladies and gentlemen, please welcome Professor Robert Engle III.
Well, thank you all for being here today. Thank you, Dean. Thank you, Ian. Thank you, Professor Pundit. It's a real pleasure to be here at Sasin today. I've always enjoyed Thailand, but I have not been with you before, and so it's a great opportunity for me to talk to you a little bit about what I'm interested in and what I think actually are some of the things that you're interested in as well. Are we getting an echo from this? Is that better without it? Yes, okay. I thought that might be the case. So I would like to talk to you about climate change, but I have a particular idea of what's interesting about climate change, and that is the risk of climate change. And so often I get asked what this little medal is for, and I guess I could give the answer in a few-hour lecture, but I want to give it in a sentence. It's a way of measuring risk in financial markets. It's a statistical method for measuring risk in financial markets. So, in fact, this Nobel Prize was given because it's a way we can measure quantitatively risks, and particularly useful for financial markets. So, how does it work? I don't want to talk about that today. It's got something to do with heteroscedasticity, absolutely, but it's not what I want to talk about. I want to talk about, first of all, oops, wait a minute. I want to talk about, first of all, what we use this for, and I'm going to show you a variety of pictures today which are on a website called VLab, or Volatility Laboratory, which are based on ways to measure risk. And this is a plot of where are the risks. And the upper left-hand box is what countries have the most risky stock markets. Well, Turkey is on the top of the list, and then this is sort of the top 10 countries. On the lower left is top currency volatility. And here the South African rand is the first and the Russian ruble is the second. So these are risky currencies. The third is industries, and healthcare, technology are the top most risky industries. And in the bottom is commodities, and the Baltic Exchange measure of transport costs is top, but then there is natural gas, palladium, coffee, and sugar. And so this is an example. So we, on this website, apply the models that I got the Nobel Prize for to 10,000 or 15,000 assets every day, post summary statistics like this about them. So that's one way of looking at risk. Another way we look at it is to plot it on this kind of a map. And this map tells me where the volatility is high and where it's not so high. Red is high volatility, and you see we have Argentina, India, China, but not, and actually this is about 2 weeks ago, Thailand is kind of yellowish. Actually, I looked today, it's green now, for all that's worth. But in any case, this is kind of what I've been doing over the years. But I want to change the way we think about this, because these volatilities are risks that materialize in the short run. If you invest in one of these stocks or something like that, there's a risk that it'll go down. And the volatility measures how big that risk is. But we're going to be interested now in climate risk, which is not a 1 day, 2 day, 1 week, or 2 week risk. This is a long run risk. And what do we mean by climate risk? Well, the science tells us a lot about what's happening. The science says that the world is warming, but really the key is, what does economics say the consequence of that is? Economics says that this is likely to lead to lower population, lower productivity, population migration, stranded assets such as fossil fuel reserves, and maybe more importantly, stranded capital and stranded land. It's going to lead to global conflicts and reductions in the quality of life, and possibly the end of our species. So it's pretty hard to figure out all this stuff that could happen. We see already a lot of effects of climate change around us. That's been alluded to this morning. You see it in the air. I've been told you can see it in the salinity of the water in Thailand. You can see it in the severity of the storms. But the reason for being particularly concerned is that the worst effects of this are likely to arrive many decades in the future, if at all. So we see some aspects of climate change already. But when we talk about finance, we're talking about investing in something that has a long horizon. And asset prices have information about our expectations about the distant future. And so when we think that climate change is going to be severe in the long run, one way that shows up today is in asset prices. And so we can measure the impact that is expected by the financial markets by asset prices today. And this is terribly important because it's asset prices that channel financial reserves into maybe renewable energy or whatever task there is if the asset prices suggest it. So if you don't really think that people take the future seriously, take a look at two examples from the stock market. Tesla stock, at least when I did this slide, was selling for 60 times its earnings, whereas General Motors is selling for 5 times its earnings. So this suggests that the stockholders are willing to pay for the distant future of Tesla a lot more than they're willing to pay for the distant future of General Motors. So asset prices do have a lot of information about what we think the future is going to look like. All right, so let's start from the beginning. What is a risk? A risk is some bad event that's in the future that could happen. It's got a probability and a severity. And once you have an idea of what the probability of it and the severity of it is, you can decide what to do about it. You can either try to avoid this risk, you could try to change the probability or the severity of it, or you could just try to not take part in it. Risks, or the other side of risk, is often opportunity. So when you decide to take a risk, it's because it gives you a reward. And finance is full of the risk-reward trade-off. In fact, it's really the fundamental mechanism underlying asset pricing. So climate change is mostly about long-run risks. And so this gives us the ability to look at asset prices that are sensitive to climate change as giving us indicators of how severe it's likely to be, at least according to the market today. Now, partly this is uncertainty about the physics of climate change, but more it's uncertainty about the policy of climate change. Policymakers have to decide what are they going to do about climate change, and if you think the physics is pretty predictable, policy is not. And so we use the word risk to emphasize that we don't know what's going to happen at all for sure, and we must form subjective measures of what we think policymakers are likely to do in the future. And that's what we see when we look at asset prices today. So I'd like to start with an example. And this is to suppose you're the owner of a beachfront luxury hotel. Okay, there are a lot of such hotels in Thailand. There are a lot of them in the US. But they face a lot of long-run risks, but one in particular is that sea level rise is happening. And so this hotel is likely to have a lifetime which is finite. We don't know when it's going to be destroyed by a big storm, but we know that as the sea level rises, the probability of storms will get bigger and bigger, and ultimately it's going to be gone. So this is likely to be what we call a stranded asset. It's an asset which is basically going to succumb to climate change. So what should you do as owner of this hotel? How do you manage an asset that has a finite lifetime like this? Well, one thing you might try to do is sell it. But of course, in finance, we believe that everybody knows sea level is rising, so you can't get a good price for it. Selling it wouldn't do any good. The second thing you might do is to decide that it's not worth renovating this hotel because you're going to lose it anyway. So you might do a lot less investing in the future. That actually is going to increase your profits because you don't have to spend the money on renovating. So you might actually look a little more profitable because of the finite lifetime. Another thing that happens is if other hotels are facing the same thing, they may not renovate either, and so you might expect that there would be a reduction in the supply of hotel rooms, and when the supply is reduced, the price goes up. That's economics. And so you might expect even more profitability because of this rising sea level risk. Well, suppose you have investors, or maybe you want to sell your hotel to stockholders. Would they pay anything for a hotel that's going to be destroyed like this? Well, it has value. And there we have the beginning of the finance on this. Finance says this hotel has value, even though it's got a lifetime that's not too long. Where's the value come from? Well, it comes from all the cash flows that you have, and these are now bigger because of the way you've reduced your investment. The theoretical statement of what an investor would be willing to pay for this share of stock would be the present discounted value of the earnings over the lifetime of the asset. Now, the lifetime of the asset is uncertain, so you're going to have to take expectations of that, and you're going to have to take expectations of the earnings, but basically that's the formula. There might, in addition, be a risk premium in this that you would want to add on to it. So this asset certainly has value. And and this value is going to go up and down. It's going to go up and down depending on when the termination risk is likely to be. In other words, if something is happening so that termination risk is coming sooner, then the value is going to go down. If it goes further in the future, the value is going to go up. In addition, there's demand. So if demand for the rooms goes up, the value of this asset will go up. So it basically has two drivers to the price. One is the climate change part, and the other is actually ordinary demand for vacation space. So this is an example that I'm going to come back to today, and I'm going to give it a name. I'm going to call this termination risk. And when faced with termination risk, I think any business faced with termination risk is likely to follow these kinds of strategies. And I think another example of termination risk is the fossil energy sector. Oil and gas, coal. These are facing a future that looks a lot like this hotel. So just to say a couple more words about what we might expect when a company faces termination risk. From an economics point of view, a dollar of investment will increase your capability of producing output one period ahead, 2 periods ahead, many periods ahead, because the investment actually depreciates gradually over time, but it lasts a while. So that when you do the calculation of the marginal product of investment, the horizon actually matters. Secondly, if output increases, the demand side goes up, and the termination is fairly close, you're not going to see much new investment. You're not going to see firms increasing their supply of hotel rooms if they really think that it's only going to last a few years, even when demand goes up. So we might expect less supply elasticity to increased demand. The third thing is you might want to buy insurance, but what's the insurance company going to charge for this property? They're going to charge a lot, and over time it's going to go up. Because as the probability of destruction goes up, the insurance rates should go up. So it really might not be a very attractive thing to do. But one other thing that might have occurred to you is that when you have a lot of these beachfront hotels, it might make sense for them to consolidate so that they can actually reduce their supply of hotel rooms in a way to maximize monopoly profits. And I think this is something we see happening in the energy sector. We're seeing a lot of consolidation in the energy sector, which I think could be interpreted as one company decides it's ready to terminate and they sell it to another company. And the second company says, we can achieve economies of scale with the two together, and we can extract more monopoly rents by reducing our output. So the fact that we see oil companies buying each other does not mean that they think the future is good. It might mean that they want to manage the termination more effectively. Okay. Is termination risk really a plausible explanation for fossil energy companies? Well, if you think about the Paris Climate Agreement, we, as most countries around the world, declared that they were going to try to get to net zero greenhouse gas emissions by 2050 or something like that. The International Energy Agency has come up with a model for this, and it's shown on the screen here. Let's see, well, there was supposed to be, I think, anyway, the dark blue is coal, the turquoise is natural gas, and green is the oil. So you'll see these were growing in the past. The peak of this is just more or less today. And what they're saying is, what we have to do is reduce all these energy demands. These are electricity for creating electricity. Reduce them over time until at 2050 they're at zero. And so they talk about what we would have to do. We have to start creating hydrogen. We have to stop investing in coal power and use carbon sequestration and so forth. Looking at this picture. So if you're the energy CEO and you see this picture, you say, whoa, I don't know whether I believe it, but if I do, I've got termination risk. So a risk means not that it's going to happen, but that it might happen. And you might have to take it seriously because there's a chance this will go to zero. There's a chance it'll not get to zero, but it'll still be a bad outcome. Sorry. At the same time, we have to ramp up our investment in fossil energy, in renewable energy, and we're not very far up this curve either, but this is where we're supposed to get to by 2050. So this is, a lot of people talk about these two pictures. This is the challenge for our times. How can we actually make this happen? But I'm trying to think about this as, what does this tell me as CEO of a fossil energy company? What does this tell me I should do? It might tell me I should invest in solar, but I'm not sure that my investors are going to give me the benefit of, even though when I've been a fossil energy company, can I really become green in terms of investors' point of view? Investors are more likely to want their money back and let themselves choose what renewable energy companies to invest in. So I think that the effort for fossil energy to turn itself into a green company is pretty hard. So what do we see when we look at the data? Well, there is a piece of good news in here. Here's coal. Coal has been coming down. And in fact, it peaked in about 2006 or something like that. That's good news. But crude oil and natural gas are rising quite dramatically, and nuclear and renewable energies are increasing, but not nearly as dramatically as the picture. So there is some evidence that we're moving in the right direction, but it's maybe not enough. So how is it supposed to happen? When Thailand went to Paris and said, we're going to be net zero by, I think Thailand might have said 2060, I can't remember. 2025? 50, 51. 65, okay. Anyway, how are they going to get there? I mean, what kind of policy do we put in place to do that? I mean, we can't force people to do this. So here are 4 strategies, sort of generic strategies. The favorite one by economists is tax carbon emissions. This is carbon emissions are an externality. Tax them, it's a natural solution. Without thinking about it, that's what most of us economists would say was the best thing to do. We're not seeing it everywhere. We're seeing it in a few places, but not everywhere, and certainly not comprehensive across all assets. The second choice is to subsidize renewable energy. The first one raises revenue, the second one takes revenue, but from a public finance point of view, that might not be important, but from a political point of view, it probably is important. So subsidizing renewable energy is the second way, and actually the US has now finally got a sort of a climate program which is in the second category. Third is to regulate emissions, and that says have the government or the court say you cannot emit more than this. We do this with automobiles, but it's pretty hard to do it comprehensively, but we could imagine that that's one of the strategies. I mean, the government could say, no, you don't get to do any more emission than this, you don't get to do any more than that, blah, blah, blah. And so that would stop emissions. And then the fourth one, I call it hope, but this is the one that most of us are using, which is no policy at all, but it's hoping that the private sector will be sufficiently concerned about climate change that we'll do it ourselves. That is, consumers start buying green things instead of brown things. Employees only want to work for green companies. Investors want to invest green. Corporations, we all voluntarily adopt greener behavior. And it's conceivable, I guess, that this would be a sufficiently powerful force that it would get us to the net zero in 2050. Most people are pessimistic that this is actually a strategy that's going to work. It's much more likely that we'll follow green behavior when it becomes cheaper than brown behavior. Okay, so when we talk about these policies to decarbonize, we're talking about transition risk. The hotel was facing what we call physical risk, which is that the physical environment is going to do damages. Transition risk is a risk that we are imposing on ourselves by trying to decarbonize. That is, companies that are producing a lot of greenhouse gases are going to be asked to stop. And those companies will be unduly hurt by decarbonization policies relative to companies that aren't. So we call this transition risk, and so it's common to think about there being 2 types of risk for climate change: physical risk and transition risk. So fossil energy companies particularly are facing transition risk. They might face some physical risk from from storms in the Gulf of Mexico or something like that. But the main thing is transition risk, and as you can see, this is very politically connected, and it's politics that are going to really determine it. And when you're the CEO of a fossil energy company, you're continually going to be interested, what is the public opinion like today? Is the public going to vote for policies which impose transition risk on my company or not? And so it's a political issue, and the worse the climate gets, the more likely the population is going to say, that's enough, we've got to do something about this. Stop the emitters from emitting. Okay. So this leads us to, what should investors do? Investors, you know, I a little bit lost track of when we started. Dean, where are you? Yeah. What time do you want me to be done? Because we've got a little bit of a late start, but 10 minutes? Okay, well, a company that's exposed to long-run risk is not as good an investment as one that is not. So therefore, there has to be a risk premium to make you take this risk. So you would expect a positive risk premium for holding companies that are exposed to this risk. These are the same energy companies we're talking about. So they should have higher expected returns and be able to sell their stock for less than a green company. Investors, however, who want to invest in the green transition will want to be short these energy companies, and therefore are going to have a negative risk premium. And so we're going to talk about hedge portfolios as being portfolios which are overweight in stocks which are going to survive effectively in a high-risk climate environment, and underweight stocks that don't. That is, they could be a long-short portfolio or just overweight and underweight. So this is kind of a natural strategy for investors who want to reduce their climate risk, or maybe have a view that the market is currently underpricing climate risk and that price is going to go up over time. So how do we construct climate hedge portfolios? So what we want is a portfolio. We need to decide which stocks are going to do well in a bad climate environment and which stocks are not. And we want to invest in the first and short the second. We could do this either with fundamental information, things like firm characteristics like ESG and stuff like that, or we can do it with statistical information. And the statistical information is of the following form. Suppose there is news that the climate risk is going up. Maybe we read about more hurricanes, or maybe we read that some candidate for president that doesn't believe in climate change is likely to win. Then which stocks go up and which stocks go down? This is a way of telling what the market sees as the long and the short part of this climate hedge portfolio. So if you do, two examples of this are, one is what we call our stranded asset hedge portfolio, which is just dependent on 3 exchange-traded funds. It's long the S&P 500, short 70% of a coal ETF, and 30% of the broad energy ETF. This is using firm characteristics to decide what we think the climate hedge portfolio would be. An alternative approach is the second one, which we call a climate-efficient factor mimicking portfolio. And this is in a paper by Jean-Luc Denard, Brian Kelly, in myself, which forms long-only dynamic portfolios of publicly available climate funds. In other words, it starts with a whole collection of funds which are supposed to be sustainable. I mean, they're advertised as being sustainable, but we all know that some of them are going to be better than others. And asks, can we make a portfolio of those that does better than just, say, an average portfolio or something like that? And the answer is yes. What we want to do is form a portfolio which has minimum variance and maximum correlation with the climate news. And that's taking advantage of this idea that the news tells you when some stocks, which portfolio is going to go up and which portfolio is going to go down when we have climate news. And it turns out that this portfolio, we call it CEP for Climate Efficient Portfolio, we estimate it over time, and every month we re-estimate it, and we post it on the internet, on the VLab, say, okay, this month we're holding these 3 stocks, or these 3 funds, or this fund, or 7 funds with these weights, or something like that. So it's fully investable. So let me just show you a little bit from VLab on the climate section. So CEP in November had 3 funds in it. In December, it had 2 funds. In January, it had 3. January 24, it had 3, but January 23, it had 3. But they're not the same. So there is over time, the funds that this picks are changing. And that's because probably either the fund management is changing or the environment is changing, so that different aspects of sustainability turn out to be the most profitable and responsive to climate news. So how do these funds do overall? If you look at the whole long run, the first 2 are the ACWI and S&P 500. So these are kind of benchmarks for what you see. And you see the return over the last, 15, 30 years, whatever, are positive. The volatility is there. And here's the Sharpe ratio in the last column. So this is kind of the standard for what you might do with evaluating a fund. If you look at the stranded asset portfolio, you see this has a positive return and actually a Sharpe ratio which is slightly higher than the S&P over its sample period. If you had done the stranded asset portfolio just with the whole energy sector, it actually doesn't do as well. In fact, it has a negative return over 25 years. So the weights, 70% and 30%, turn out to have been smart to do. And the climate efficient factor mimicking portfolio also has positive return. Actually, it's quite a healthy positive return over 20 years, and a Sharpe ratio which is a little lower than that. Great. But, and if we look at the 1-year return, it actually looks even better. I mean, look how amazing first of all, the S&P has a Sharpe ratio of 1.4 for the 1 year ending whenever I did this, which was, I think, January. Stranded asset portfolio has a Sharpe ratio over 2, and climate efficient is about a half. Those are all pretty encouraging numbers. But if you look at what these same tables were showing last year, on March 31st, you see they all had negative returns and, of course, negative Sharpe ratios. And by May of 2023, in other words, just sort of 2 months later, they were sort of positive, but very low Sharpe, and the CEP was negative. So that there's something was happening last year that was really devastating these sustainable portfolios, these hedge portfolios. So what do we do with these climate factors? Okay. We could invest in them directly. Or we could invest in portfolios that are correlated with them. So by correlation, what we might mean is that if you regress the returns on this portfolio on standard risk factors and then put in a sustainable fund, you'd like to know that the beta on the sustainable fund was fairly substantial. We can use the same thing as a test for greenwashing, and we could use the same thing as a test to see whether banks are investing in assets that the market views as green or assets that the market views as brown. And so this is the basis of stress testing banks as well. So once we have these hedge portfolios, we can talk about greenness in a lot of different settings. So let me just show you a couple. This is also a table from VLab. These are funds on the left-hand side of which we've got about 200, but this is the top 10 of them, sorting them by their beta on the CEP fund. So here we've got the return, volatility, Sharpe ratio, correlation with the news, and CAPM alpha. Don't worry about details of what these names mean when I just say them like that, right? But these are the betas that I just talked about. These are telling you whether these things are correlated with a CEP or correlated with a stranded asset. And the one that's most correlated with a CEP turns out to be a solar ETF. Okay, that makes sense. But then you go down the list, here's a clean power, clean energy, battery. You know, these are portfolios, at least in their name, have these kinds of characteristics. And this beta is a way of measuring how correlated they are with this hedge portfolio. You can also rank them by correlation, by the beta on the stranded asset, but I won't do that. So we can do the same thing for individual stocks. We can regress the return on an individual stock on these climate hedge portfolios as well as standard risk factors and see what the beta is. And if it has a high beta on a hedge portfolio, that means it's got green characteristics. And regardless of how it's advertised, you could get the performance that's correlated with this green portfolio. We do a couple more portfolios. I'm not going to tell you about that. We do it this way, and here's kind of what we see. On the left-hand side are the top 10 stocks in the S&P 500 from the green point of view. On the right-hand side are the bottom 10 from the S&P 500 that have the most negative correlation with these hedge portfolios. So this is a way of separating the funds that you might want to be overweight in and funds you might want to be underweight in. So this is part of a research project which is ongoing to try to estimate these betas, see how they correlate with ESG data, and see how they change over time. We can do the same thing with bank stocks, and let me just show you here. So if a bank return is a function of the market return and a climate hedge factor, then this beta on the climate tells you how sensitive the bank's stock is to movements in climate risk, and climate risk as incorporated into these climate hedge portfolios. So the beta here is a measure of exposure, and we also use it to calculate a measure of capital adequacy. And we've done it for, I think, about 10 Thai banks and insurance companies, as well as about 1,000 other banks around the world. And we update it every day, and you can see on your phone. It's a free website, and it's got a lot of information in it. The banks that are sponsoring this event are definitely in this list. But I'm not going to tell you what it says about them. So I am going to show you what it shows about Citibank, because we can all worry about Citibank. And this is the climate beta for Citibank from 2019 up to the present, and you see it fluctuates around. One of the things we see is in the 2020 and 2021 period, the betas are positive. So this is a time, this is during the pandemic. And during the pandemic, we see behavior in almost every place we look that looks a lot like extreme decarbonization, because we stopped using as much gasoline, we stopped flying, we started zooming instead, and that was very hard on the fossil energy companies. Their profits went down, the hedge funds responded and showed great positive returns during that period, and it looks like the banks were more correlated at that point. They've gone back down again, but then, you know, the advantage of doing this at a high frequency level is you see something like this going and you say, suppose that's just noise, or is that a trend? Stay tuned. We'll see. Okay, so I'd like to now, as my final topic, I want to come back to the question of why were these sustainable funds and benchmarks so bad last year? Why do they underperform last year? Some of you probably have an idea already. But this is what the Emperor said. This is the Emperor from Star Wars. I don't know whether you all know the Emperor from Star Wars, but one of the things he said is, everything is proceeding as I have foreseen. And this is a very ominous statement, but the question that I raised by putting it up here is, did we foresee that this was going to happen? Okay, so what is the explanation for this? Well, most sustainable funds are underweight the fossil energy sector. It turns out the fossil energy sector did really well last year. And so its high returns were in the S&P and other broad indices, but were not in as part of sustainable funds. So that's sort of the easy answer. The hard answer is why? Why did fossil energy companies do well last year? And I think termination risk has something to do with it. I think as we look at it, the fossil energy companies certainly must have recognized the risk that they are facing of termination in the next decade or so, and reduce their investment. Do we see them reducing their investment? We do, actually. I can't remember whether I have a slide that does it or not, but we have certainly evidence that investors think fossil energy companies don't have a long horizon. How do you know that? Well, if you look at price-earnings ratios, they basically tell you, do you think this company has a long horizon ahead of it or not? You can even interpret a price-earnings ratio in terms of the number of years of returns approximately that you can, number of years of earnings that you can kind of expect to get. And stock prices are very low for energy companies. PE ratios are low, but earnings ratios are high. Similarly, price to book ratios are actually very low as well, indicating that the book value of energy companies is much higher than its market value. And That's not surprising if they have all these oil and gas reserves which are on the books but really aren't going to be worth as much as they paid for them. Okay, so we would expect firms with substantial termination risk to have low PE and price-to-book ratios. What do we see? Well, here is the price-earnings ratios by sector, and if you look across the bottom, here's energy. Here, this is for 2021 and 2020. If you look at price-to-book ratios, energy is still on the right-hand side. If you look today at what price earnings ratios are for energy sector, they're about 8. So that says sort of 8 years. 8 years of earnings, kind of like what they've been getting. And then you look down here, here's technology at 38 times earnings, a much longer horizon. And you see in the green circle here, the earnings per share over the last 5 years increased 26%. That's almost the best of any sector. The earnings per share are now valued at increasing 1% over the next 5 years. So even though earnings per share rose dramatically over the last 5 years, the market is pricing a very low rate of increase going forward. And within the energy sector, you see thermal coal is the worst. Uranium, if you include that, has a price-earnings ratio of 81. I don't know what to make of that exactly, but when you look down there, you can see they're all pretty low, although some are, the oil and gas producers are basically the lowest. Okay. Now I want you to think a little bit bigger, and then we'll stop. Countries may face termination risk of their major industry. Think about countries that have their biggest industry is oil and gas. And we can think of a lot of them like that, but the Middle East comes to mind immediately. What if you're a policymaker in the Middle East, what are you supposed to do? Well, you're going to want to follow some strategy to deal with the termination risk of your biggest source of revenue. And I think the natural thing to do is to try to reduce the impact by diversifying. So you can see the Middle East is all taking revenues from their oil and gas industry and building new kinds of industry. The transportation, the air travel and so forth is a big investment. They have a lot of tourism, sports. They're spending a lot of money on trying to get sports going in the Middle East. Universities, there's a lot of money available, and they're pouring it into trying to get additional sources of revenue going forward. What about Russia? Russia also has oil and gas as its biggest industry. Is Russia trying to diversify? Well, in a way, I think maybe so. If it owned Ukraine, it would have a lot more capabilities of agriculture and natural resources than it does without Ukraine. And so I think this could be part of the motivation for Russian invasion of Ukraine. I think also it's pretty clear that if your oil and gas industry is going to be worth less in a decade than it is today, it's going to be harder to do an invasion in a decade than it is now. And secondly, Europe would be much more prepared with its own renewable energy sources in a decade than it is today, so that the environmental effects are really two. One is that Russia's resources are higher now than they will be in the future, and the second is that the rest of Europe will be better able to deal with would be better able to deal with energy shortages in a decade than they are today. In any case, I think that termination risk is likely to be an effective part of understanding what is going on in the Russia-Ukraine war. It's always been so. Should we be disappointed that these sustainable funds are underperforming? Not entirely, because one of the things that has to happen in order to decarbonize our economy is that the prices of fossil energy has to be high. And here, this termination risk has made the price of fossil energy high. People complain because their gasoline is so expensive. People complain because, you know, they can't afford to heat their houses so much. And that's exactly what economists say is supposed to be the way we decarbonize. If people stop driving their gasoline-powered cars because they're too expensive and buy a Tesla, they're doing what is supposed to happen. If they take the bus, that's what's supposed to happen. If they turn down the thermostat in their house, that's what's supposed to happen. It may not be equitable, and we may need to, you know, provide more resources to low-income people so that they don't starve and whatever. But in fact, everybody that goes to the gas pump and says, this is too expensive, I'm not going to drive as much, is doing the work of decarbonization. Okay. Would it have been different if we had actually imposed the carbon tax, which, again, as I say, most economists would be in favor of? Well, it would have been different in the following way. I think energy companies would still be behaving with respect to termination risk, but their high profits would actually be taxed. And so their stock prices might not go up so much because the tax rate on emissions would be high. And so the difference between having a emissions tax and not having an emissions tax is that it's the stockholders that are getting the benefit of the high energy prices now, whereas it would be the government that would have the benefit in the case where we had an emissions tax, and they could use that to support low-income people who were being unduly impacted by the high energy prices. So it would have been a good thing if we had it. It might be that it's not too late to put it on, but that's, I think, what would be different. Is it still a good idea to buy a hedge portfolio given the underperformance in the past? Well, if I had asked this question last year, which I did in various talks, I gave the same answer, which is no, it's not too late. It still is a hedge. But it turns out that that hedge, if you bought it last year, has done very well this year. So the temporary underperformance of the sustainable funds does seem to have been temporary. And so the final question is, what about termination risk for the planet? You know, let's ask really the big question now. If we think that termination risk is bad for a firm and even worse for a country, it's pretty terrible for the planet. So what are we supposed to do about that? What should policymakers do about termination risk for the planet? Well, the answer, I think, is encapsulated in what we've said, but if we can all get ourselves to net zero by 2050, the argument goes from the scientific point of view, that would be sufficient to eliminate the worst outcomes. Now, suppose some of us do and some of us don't. Well, it seems to me that if the biggest emitters can agree and get themselves to net zero by 2050, then the smaller emitters will actually not contribute that much and will actually be motivated and technologically influenced to do the same thing. So I think the key to reducing termination risk for the planet is for the US, Europe, China, and maybe India to have some sort of agreement, cooperation, that we all are going to do this. And if we can get it done, that will be enough to avoid this termination risk. So I'm not so happy that the US is on track to do this. Many people are not happy that China is on track to do it. The Europeans are more committed than either of us are. But I think we need to push our politicians to do what really makes sense to reduce our carbon emissions. And so here are 3 of my 5 grandsons looking out over a quiet, still lake, wondering what kind of world will they inherit. They're very worried about it. And if we can tell them that we have a solution, they'll be very happy. Thank you.
Thank you, Professor Engle. And now, as we transition to our panel discussion, this is the section of the afternoon where we get a little bit interactive. We're going to offer you an opportunity to ask some questions through a QR code, which you'll see on the screen in just a minute. And when you have a Nobel laureate in economics on stage, you want to put somebody on stage who can have a conversation with them. You don't get the humanities guy to go up there and do that. You get an economist and you get a finance professor. And we have asked 2 of our best to join Professor Engle on stage. First, the economist, Sasin's Deputy Director, Professor Piachart Peter Omswat. And then the finance professor, Sasin Professor Patanaporn Chajut Hatmad. I always screw that up. Now, as I said, this is an opportunity for you to ask some questions. So on the 2 side screens now, they're going to put up the QR codes. Just scan the QR codes, and we will get to your questions shortly. But now let me turn things over to Dr. Piachart.
Thank you so much, Dean. So, first of all, on behalf of everyone at Sasin, we would like to thank you so much. We have, again, at Sasin, sustainability is also one of the topic that we think it's very, very important. And it's not important to, just Thailand, but it's important for the whole world, right? So we thank you for that very much. So we're going to start off, me and Ajahn Patanaporn, we might start off with a few questions. But most importantly, I think we want to encourage you all to actually ask questions from the QR code from the Pigeonhole, right? So maybe I start off with a very, very basic and broad question. So you talk a lot about, from VLAB, right? Let me ask you this. So what is really the key motivation that you actually decide to create this?
Switch, right? So we actually started VLAB during the financial crisis in 2008, and that was an effort to publicize what was happening to volatilities and correlations and actually bank stocks over that period. We think of this as a public good. We're trying to inform people about risks, and the more people that use the website, the better we like it. And so we also have a sort of a goal, which it's kind of an econometrics idea, but we often estimate our models and then do out-of-sample forecasts. But usually an out-of-sample forecast is just some data that we didn't use in the estimation, but we already see it. In our case, we build the model, put the computer code on the computer code in the cloud, and it does the calculations every day for another decade. And you really get to see out of sample in a way that what you can't really do as an econometrician. And so I think it gives you a sort of discipline about how do you build models that you think are really stable and really won't be messed with by new kinds of events that you didn't know about.
Got it. Very interesting. And another one from me, and then maybe from you. Just quick one. I'm continue from this. When I listening to you, and then I wonder about one thing, which I want to get your opinion about. And again, you know, this V Lab, you build this model, and I think one of the key conclusion from this model is that it actually show evidence that investing in something green should be something good, right, for the investor point of view. So do you think something like this will play some role, maybe, you know, enhancing the hope that you're talking about, that we hope that investor will interested in green stocks or green fund, company will want to do, you know, good for the environment more, and consumer will do alike. What do you think about this?
Well, I think that we do think that is a goal, but I have even a better goal, which is if government were to put on a carbon tax that was an effective one, then investors wouldn't have to try to figure out what was green and what wasn't. They just buy the cheapest, best performing stock, and that would be the best way to do this transition. But if the government is unwilling and unable to put on these policies, then I'm hoping that the private sector, following what you said, can do at least part of the job.
I see.
Okay, so it's my turn now. Okay, very interesting about your financial asset pricing model. We all know that, you know, we learn about CAPM, we learn pharma and French, right? But this is by adding the climate risk into the model. And you have talked about transition risk, you talk about termination risk. And we know that the net zero are going to, you know, we plan to have it by 2050. Do you think that that really will happen in the future or not, given long risk, long-term risk?
Well, I don't know. I think it's possible that it will happen, but I think if it's going to happen, it's going to happen because we'll start to see climate events that are so extreme that we're going to say, we have to do something. Because really what the investment in decarbonization is supposed to be is to give us a better life in the future than if we don't do that. Well, we see it as a cost, whereas in fact, it should be an investment in our own future that pays off. Right. And so I think when it looks like the future is really going to be horrible, we'll decide we can do it.
I see. Maybe one more from me, and then we'll see whether we have a question from the audience, right? So maybe I wanna ask your opinion about one thing. So again, you are Nobel Laureate. There's also another Nobel Laureate, right? Richard Thaler, right? So from the perspective of behavioral economics, right? Again, people are pretty bad at incorporating things that will happen in the long term, right? So do you think is there anything else that we can do, given that again to really encourage government to really do what you just said, for some country it might work, for some country it might be a big challenge, right? So is there anything else we can do? Can we use behavioral economics? Can we find ways to encourage people to be, behave greener? Any opinion about that?
I don't really believe that trying to persuade people to figure out what's greener is going to be enough. Mm-hmm. I think we need to get people sufficiently worried about this that they vote for politicians that are willing to put in the policies that are needed. I think that's more efficient, really. I think anything we individually do to reduce our carbon footprint probably contributes, but it contributes
very little.
Very little compared to what's really needed. And it's complicated. How do you know what your carbon footprint really is? When you buy something in the store, you don't know anything about where it came from. And so I just think it's likely to be ineffective to do that.
I see.
Okay, I have seen lots of questions on the screen. Do you want to move to the audience?
So Kun will help show that on the screens.
Because we have only 10 minutes left.
We have 10 more minutes.
Okay.
Okay. Maybe I help ask the first one. So since climate change doesn't have boundaries between countries, how can the world ensure that every country is held accountable to their effects on climate change?
I wish I could answer that question. It's hard. This is actually the problem. We don't have a world government that's got any ability to force countries to behave. We form groups and we try to convince each other, if you do it and I do it and all three of us do it, won't we be better off? And that still doesn't solve the free rider problem, which is always going to be part of this. And so I think that the Paris Agreement is a sort of an interesting solution because it allows different countries to have different strategies for getting there, but it really relies on them achieving what they say they're going to do. And we know that's not always easy.
So it means you are talking about trust amongst people in different countries, right?
Yes.
Okay. So let's just move to the second question so I can...
Okay, they're on the side screens here. Let me...
Maybe I'll read it out.
Yeah, go ahead.
How would your model on correlation work with the companies with termination risk when they decide to invest on the transition to the greater operation?
Greener
operations.
Greener operations.
Greener operation. I can't see that. Thank you.
It's a third one now.
Okay, I see. Okay. So my thinking about this is, suppose this hotel owner that I postulate decides he's going to take his excess profit, instead of giving it to his shareholders, he's going to start an electric vehicle company on high ground. So it's not going to... So he does this for a while. Are his investors happy with this? I don't think they're happy with it. I think if they want to invest in electric vehicles, they're going to look at what's the best electric vehicle company
Yeah.
around the world, and they'd rather have the cash payback from the hotel and then invest it themselves. And so consequently, they're not going to give him as much credit for this as if he spun it off and let it be a separate company. And so I think we're going to see fossil energy companies, rather than just building a green part of their business, they're going to spin off renewable energy and let those be treated by investors as green investments, and they will remain as brown investments, facing termination risk. They'll pay back all the cash to their investors, but they have ownership
Right.
in the new
new one.
New one.
I think that question may relate to your finding. You have talked about the sustainable companies that underperform, those fossil company, right? Do you think that besides transition risk, what are other risks that can help to explain your finding?
You mean of the low PEs, for example?
Right.
Well, I mean, what goes into a price-earnings ratio is some forecast of the future. And I think, I mean, I've given this a name, but I think that the analysts who are forecasting the future for these fossil energy companies must have relatively low forecasts, even though current earnings are high relative to what they've been in the past. They probably are not forecasting that they're going to grow exponentially into the future, that they're actually going to decline. So I think, it doesn't matter whether you call it termination risk or whether you say it's a declining industry. I reached for my phone the other day and my wife said, you used to have a BlackBerry. What happened to BlackBerry? It faced termination risk.
Yes. Yeah.
And termination risk is everywhere. It's, I've talked about it like it's this new thing for fossil energy, but in fact, companies decline because they can't compete anymore.
Right.
Universities even do that. And we all need to stay on the forefront. Otherwise, we're going to get passed by somebody else. And but this is a case where you really can't. Your research can't really solve the problem.
I see.
Okay, we still have lots of questions, but I think we only have time for one or two more questions. Let me read out the
top
next
one.
one. I've got it here on my phone. The West exported its production and environmental impact and risk to developing countries. What are the best ways to get the West to help generate the funding required for SEA transition?
That comes up all the time, and I don't think there's a good answer to it. The West feels like it can't afford to do it for themselves. So really, do they have extra funding for emerging markets? Could you have guarantees that go with these investments? Guarantees that they're not going to devalue the currency, guarantees that they're not going to have a coup, and you can't do that because there is international investments carry a risk premium because there's more risk than investing domestically. And so I don't see how that's going to really work. I think one of the possible solutions, which is not fully a solution, is carbon offsets. Carbon offsets are, I think, going to be necessary for us to get to net zero because there are industries which really can't decarbonize. And so carbon offsets are more likely to be created and sold by emerging markets than by developed markets who don't have as much land and so forth available. The difficulties of that market are great, but it seems to me ultimately it could be a partial solution anyway to this.
Thank you.
Thank
One
you.
more?
One more question.
One more
Let's make it a little bit lighter, and I'm sure you've been asked this many times. What has been the biggest change for you since winning the Nobel?
You know, I never gave talks like this before the Nobel. You know, I couldn't give a talk that didn't have equations in it. This one didn't have any equations. No Greek letters.
No Greek letters.
You know, what I did before the Nobel was much more technical. I think it was useful and powerful, but since the Nobel, I get asked by the press, I get asked by nice people like you folks to come and give a talk, but they don't want to know about heteroscedasticity or whatever. They want to know about something that really is important. And I think the challenge of having the Nobel Prize is that every time you get on this stage, people expect you to say something which is really earth-shatteringly important, and it's very hard to figure out how to do that. I mean, you know, obviously you can't really do that, but you try.
Yes, yes. And I think maybe I recap a little bit. And from listening to you, I think you have done a great job. And that is, you have put climate change and climate risk as a very important topic, right? You made it clear that it's a really, really important topic. And I think one of the key conclusions I've get from you is it's really important. And we need a big solution that can create big impact. So as you have said, so choose, I don't know, politicians or whoever that will do good.
Policy maker, you mean?
Huh?
Policy maker.
Policy maker that will actually do good for the world. So thank you very much. Give Professor Engle a big
Thank
round of
you.
applause.
Yes, thank you to Professor Engle and our two panelists, Dr. Piachard and Dr. Patanaporn. Please stay seated, remain on stage. Now I'd like to call on Sasin's Deputy Director to come up for some closing remarks. This is, please welcome Dibyendu Bose.
Good afternoon, everyone. Am I audible? Yeah. Thank you, Dean. Thank you, Professor Engle, for those invaluable insights. You know, it felt almost like, again, getting back into an MIT classroom and listening from the professor. This time, the venue has just changed to Sasin. So if I remember, you know, one of the questions I asked you earlier, that what really inspires a Nobel laureate to keep on going? Earlier, American physicist Leo Lederman, who got the Physics Nobel in 1988, he had mentioned compulsive dedication. What he said was that what distinguishes Nobel laureates is passion for their work that engage their hearts as well as their heads. And today, when I asked you that question, you answered, respond in a similar note. It's about curiosity. It's about working on problems that really matter. And we could, throughout this interaction, understand climate risk is a real problem that the world is currently dwelling with, and we need to figure out solutions sooner than later. It was very insightful to understand from you the different elements of climate risk, and in the long term, how they can impact the global ecosystem, whether it be in terms of lower productivity, the population migration, global conflicts, quality of life. You know, earlier, our president and our director had mentioned about sustainability being very close to Sasin, what Sasin embodies and does as an institution. And herein, you were talking exactly in those aspects. And it's good that that now the corporates, the private bodies are also taking care of that, and even the investors are making organizations act on those fronts, right? example, a glaring example, that a Tesla stock price today is 60 times its earnings, whereas GM's is less than 5. So those are real examples of how the investor community is also recognizing risk. Then you talked about the fossil energy companies turning into green companies, that being very difficult. And you explained us the concept of the termination risk and the government policies, the 4 types of government policies that need to be undertaken, whether it be in terms of taxing carbon emissions or subsidizing renewable energy or regulating emissions. And finally, the eternal hope that keeps on driving to solve some of these problems, right? And the transition risk is also an important element that needs to be built in for the asset pricing for long-run risks. I hope as a student I was following what you were teaching, and so many of us took notes on that front. But in the long horizon, I do hope that the learnings that you are sharing, you mentioned that after being the Nobel Prize winner, you have been traveling around the world and giving such insightful knowledge sharing that should help all of us become more aware and continue on our path of making a difference in this world. Finally, on the target of net zero by 2050, we do see the point in terms of the governments of bigger nations like US, Europe, China, India, setting the tone for others to emulate. But again, it's the journey of 1,000 miles begins with a single step, and we are all moving in that direction, and we are optimistic about it. And hopefully, with luminaries like you showing us the path, we all will be able to head in that direction and leave this world to be a better place for our children, our grandchildren. Thank you again, everyone attending here today, and the Sasin and Bridges Network for organizing this, and the Peace Foundation. And hopefully into the future also we'll have more such insightful discussions and play our part in making a better world. Thank you.
Okay, thank you, Deputy Director Bose. You can stay on stage there. May I ask Director Ian Fenwick to come up on stage and present a token of appreciation, and then we will have a few photos. As I mentioned earlier, after we conclude, there are refreshments outside in the foyer area, just outside Sasin Hall. So you're welcome to join us, and please continue the conversation, meet some new people, get to know each other, and I'm sure everybody here on stage will be there. Can I ask Deputy Director Montana as well to come up on stage? Sorry, can I also ask Mr. Morawetz to come up on stage as well from the International Peace Foundation, please? Thank you again, everyone, for coming. Can we give our guest speaker one more round of applause for a very insightful presentation today? And to the International Peace Foundation and Bridges, thank you again for coming. Please join us outside in the foyer for some refreshments. And as I said, please continue this very important conversation. Thank you again.